Welcome back to Investing Talk Podcast. Our mission, as always, on these deep dives is to take the information you share and really dig into it, uncover the key insights, maybe some surprising facts. Today, we're focusing on Robin Energy, a company that's definitely seen some, well, dramatic action lately. It's a fascinating mix, really opportunity, but also some significant risks. Our goal is to walk you through what we're seeing about its financials, its business, what's been driving that stock price, and the challenges ahead. Think of it as a quick way to get up to speed on a pretty complex situation. And before we jump in, if you find these sessions valuable, please take a second to subscribe, maybe like this episode, leave a comment with your thoughts, questions, and hey, consider buying us a coffee. Your support genuinely helps us keep doing this for you.
Okay, let's start with the basics. What exactly is Robin Energy? Fundamentally, it's an international shipping company based out of Cyprus. Its main business is moving refined petroleum products around the globe. They use tanker vessels for this.
Right. And something specific jumped out right away. The company currently owns and operates just one tanker, a handy-sized tanker. Why is that detail important?
Well, the handy-size classification is key. These tankers are smaller than the really big carriers. This means they have more flexibility. They can get into ports, navigate waterways that larger ships just can't access.
Okay, so that could be a strategic edge. Maybe you reach different markets or routes.
Potentially, yes. It could enhance their operational effectiveness, let them tap into niche opportunities.
Makes sense. Trading scale for access, perhaps. And the company itself, it's fairly new to the public markets, isn't it?
Very new. It looks like it was founded by Toro Corp only in September 2024 and then listed on Nasdaq just this past April 2025.
So yeah, a very short public history.
Exactly. Which brings us right to the main event, the thing that probably got everyone's attention, the absolutely extraordinary volatility in its stock price recently.
Extraordinary doesn't quite cover it, does it? The numbers are pretty wild.
They really are. We're seeing a surge of up to 278% intraday. That was on Friday, June 13th. On that single day, the price went from around $3.35 up to $14 a share.
Wow. In one day. That's something else.
And it wasn't just a flash in the pan. This spike was part of 3 straight days of gains. Over about 2 weeks, the total increase was apparently over 400%.
And the trading volume matched the price move.
Oh, absolutely. Huge volume. Something like 100 million shares traded on that Friday alone. That's roughly $1.4 billion in value changing hands.
Massive volume, massive price swing. And even looking year to date, it's still up significantly.
Yes, the YTD performance shows a big jump too, around 133% or so.
Oh, okay. Numbers like that don't just happen. There have to be reasons, catalysts behind it.
Right.
So what seems to have driven this meteoric rise?
Several factors seem to be pointed to. One is a recent quarterly revenue figure, $15.6 million. Now, that number is being interpreted as a signal of strong top-line growth, maybe expanding market presence.
Okay, $15.6 million in one quarter. But wait. I also saw a figure for the full fiscal year 2024 revenue, only $6.77 million. That feels like a huge difference. How do we square that recent quarter with the previous full year?
That's a really sharp point, and it highlights an immediate puzzle here. The information presents both numbers, but doesn't really reconcile them. So while that $15.6 million might suggest things are accelerating fast, comparing it to $6.77 million for the entire previous year raises questions.
Like, is that quarterly number sustainable? Or was it a one-off? Makes it hard to gauge the real growth trajectory.
Precisely. It creates uncertainty about the actual run rate.
Okay, aside from the revenue puzzle, what other business developments were flagged as potential drivers?
There's talk about announced strategic initiatives, things like advancements in energy technology offerings, plans for ambitious market expansion. Moves like that often catch investor attention, particularly if they're looking for exposure to, companies mixing traditional energy with new tech angles.
And I think I saw something about mergers and regulatory stuff too.
Yes, exactly. Recent strategic mergers were announced with the usual expectation of synergetic benefits, cost savings, new opportunities, that sort of thing. Plus, some regulatory updates apparently cleared hurdles for more expansion. Those are seen as positive signals, tangible steps forward.
So it sounds like they're trying to paint a picture of being more than just a one-ship company, maybe a tech-forward expansion story.
That seems to be the angle. There's mention of rapid adoption of advanced tech for their tanker operations, innovative fleet management. Even with just one ship currently, framing it as technologically advanced could be a way to differentiate themselves.
Okay, so some fundamental business drivers. But the scale of that price jump, it feels like more than just fundamentals was at play. What about market sentiment, social media?
Ah, yes. That definitely seems to be part of the equation. Analyst sentiment was reportedly shifting more positive, maybe some price target increases. And broader market sentiment towards the stock seems to have been overwhelmingly positive during that surge period.
And I bet social media platforms were buzzing. A stock moving like that gets noticed.
For sure. Significant bullishness mentioned across platforms like X, Reddit. The ticker was trending. Lots of speculation about more upside potential.
So it creates this powerful momentum loop, right? Positive sentiment, social media buzz, driving the price, attracting more attention.
It certainly looks like that kind of dynamic was a major factor, where momentum can, at least for a while, maybe outpace the underlying business reality.
A potent mix. Okay, so that helps explain the explosion upwards. But we need the full picture. Let's pivot to the other side, the financial undercurrents, potential red flags, the reality check, if you will.
Essential part of the analysis. And here, the picture gets, well, inconsistent. Take profitability. One view suggests earnings per share, EPS, is probably low, or maybe even negative, pointing to financial disclosures that show negative profitability metrics, things like a negative return on assets, around 0.5%, a shrinking equity base, implying probably negative return on equity too.
So one perspective clearly points towards unprofitability, financial strain.
Correct. But then another perspective suggests there was no indication of negative earnings or distress from recent filings or news.
Wait, no indication. That directly contradicts the other view.
It does, and that conflict itself on something as basic as profitability is a pretty big red flag. It signals significant uncertainty about whether the company actually makes money, makes standard valuation tricky.
Definitely concerning. What about debt? Any clearer picture there?
Surprisingly, no. The debt situation also has conflicting interpretations. One calculation gives a very low debt-to-equity ratio, around 0.022, which, would normally suggest minimal leverage, very little debt compared to equity. Sounds good on the surface.
Okay, low debt sounds positive.
But another view highlights financial disclosures showing substantial leverage, calls it an ongoing operational headwind, a risk. And yet another take suggests debt levels are likely moderate.
Low, substantial, moderate. That's not helpful. What's the takeaway from that confusion?
The main takeaway is just a lack of clarity. How much debt the company actually carries is fundamental to risk assessment, and the conflicting information makes that assessment really difficult without digging deep into the primary financials yourself.
Got it. And cash flow. Any concerns raised there?
Yes, cash flow concerns seem more consistent. Several points suggest potential issues. One implies negative free cash flow, looking at trends like falling cash reserves and receivables. Another specifically mentions liquidity challenges, potential cash flow constraints as ongoing risks.
Okay, so unlike profit and debt, the cash flow picture seems more consistently worrying.
Based on what's presented here, yes. Cash generation and management look like they could be a significant hurdle right now.
Let's touch on valuation metrics. What did we see about how the stock is valued relative to the books or earnings?
Well, there's a mention of the price-to-book ratio, PB, being around 0.31. That compares the stock price to the company's net asset value per share.
And how is a PB of 0.31 interpreted? Good, bad.
Again, context matters, and interpretations differ. One angle is that this low ratio is a deep discount to book value, suggests it might be undervalued based on assets. However, it's also noted that such a low PB is often typical for companies seen as distressed or microcaps with very uncertain futures.
So it could mean it's cheap, or it could mean it's cheap for a reason.
Exactly. It's ambiguous on its own. Also noted is the lack of a PE ratio price to earnings, which likely stems from the potential negative earnings we discussed, and no dividends are being paid.
All characteristics often seen in early stage or perhaps struggling companies.
Right, rather than establish profitable ones.
Moving beyond pure financials, any major business risks highlighted?
A really big one stands out. That reliance on the single vessel. We mentioned it earlier. This creates huge concentration risk. I mean, it's stark. Any problem with that one ship mechanical accident, regulatory issue, anything, could potentially cripple revenue generation.
All their operational eggs in literally one basket.
Pretty much. It's a very clear and significant operational vulnerability.
And what about the volatility itself? The crazy price swings, is that viewed as a risk factor too?
Yes, absolutely. The extreme volatility is framed as a potential red flag. The thinking is, moves that dramatic often suggest speculative trading, momentum chasing, rather than just calm reactions to fundamental news. It likely has a high beta, meaning it swings much more wildly than the overall market.
So the volatility makes it inherently higher risk, less predictable.
Correct. The very thing drawing attention is also a sign of potential instability in the stock's behavior.
Fascinating. The surge itself is both a story and a risk.
Yeah.
Okay, let's broaden the view. Where does Robin Energy fit in its industry?
It's in marine transportation, focused on refined petroleum products. That sector, overall, is benefiting from rising global energy demand. That's a potential tailwind. But it's also an industry prone to volatility from geopolitics, things impacting shipping lanes, and global supply chain disruptions.
Are there wider industry trends affecting things?
Yes, there's a push towards modernization across the shipping sector, updating older fleets, and increased investor interest in companies trying to bridge fossil fuels with newer tech or more efficient operations.
And how does Robin Energy stack up against competitors? Is it a big player?
No, it's classified as a microcap, small niche market share compared to the big established shipping lines. It's seen more as a challenger, maybe a laggard currently, not a leader.
But that handy-size focus and tech angle, is that its niche?
That seems to be the differentiator highlighted, using those flexible, potentially tech-advanced vessels for underserved routes, while larger peers might stick to standard routes with bigger ships. That could be how it tries to compete.
Looking forward, what are the key risks to keep an eye on, beyond the financials and the one-ship issue?
Several others are mentioned. Things like ongoing legal proceedings related to regulatory compliance that creates uncertainty. Macroeconomic factors are always relevant. Changing interest rates, impacting borrowing costs, shifts in tariffs or trade policies affecting global shipping volumes.
And environmental rules must be a big one for shipping.
Definitely. Changes to maritime emissions standards could force costly upgrades or changes in fuel across the industry. And there's always the risk that technology shifts quickly, potentially making their current model less competitive if they don't keep innovating.
So, a lot of external factors to manage. What about potential upsides? Opportunities or catalysts that could be positive?
Several potential positives are listed. Successfully integrating any merger partners could help. Getting regulatory clearances for international expansion would be big. Obviously, any news about expanding the fleet beyond the single vessel would be significant. New strategic partnerships. And critically, the next earnings report that could provide much-needed clarity on profits and cash flow.
Those are definitely the milestones people would be watching. Was there any specific analyst view mentioned?
Yes, a hold recommendation was noted. The general idea seemed to be there's upside potential if management delivers on those growth plans, but it also came with caution suggesting maybe waiting for the valuation to settle down after that huge run-up before making big decisions.
That recommendation feels like it really captures the tension here.
It does. It acknowledges the potential excitement, but stays grounded in the risks and the current uncertainty around the financials and valuation.
Okay, let's try to pull these threads together for you. What we're seeing with Robin Energy is this picture of an emerging company in marine energy logistics. It's got some recent strategic moves, positive momentum, driving that stock price to really extraordinary levels.
But layered underneath that are significant financial questions, potential unprofitability, cash flow concerns, plus that major business risk of relying on just one vessel. And it's all happening in a volatile sector for a microcap company.
So the recent price surge seems like this blend, doesn't it? Partly genuine optimism about the future, the strategy, the tech talk, but also, likely, a heavy dose of speculative activity, maybe amplified by social media and market sentiment.
And when you encounter a company like this presenting such stark contrasts, exciting potential growth versus pretty serious financial risks and data inconsistencies, what does that tell you about trying to assess opportunities, especially in these fast-moving, smaller-cap situations?
Right. Given the extreme volatility we saw, the undeniable role of social media sentiment, and this mix of promising developments sitting on top of some shaky-looking financials.
Yeah.
Here's a thought to leave you with. In cases like Robin Energy, how much of that dramatic stock price movement do you think is really tied to the fundamental business progress itself? And how much might just be driven by the momentum, the speculation, the whole market dynamic around the stock? What do you think is truly driving the valuation right now?